A small rupees 10 note can travel through markets, buses, shops, and thousands of hands before it finally becomes unusable. But what if that same note could survive for years instead of months? Around the world, many countries have already moved from paper currency to plastic like polymer notes. Now, India is asking a big question: should our money change too? A currency note looks simple: a piece of paper with a number, a portrait, and a few security features. But behind every note in your wallet is a massive system involving printing presses, security technology, transportation networks, banks, ATMs, and millions of everyday transactions. And now, India is considering changing the very material that makes up its currency. The Reserve Bank of India has started the process of exploring polymer banknotes by inviting global companies to supply specialized polymer sheets with security features. But this does not mean plastic notes are arriving tomorrow. This is only the beginning of a trial process. The RBI is trying to answer a simple but important question: can a different type of currency make cash management cheaper, safer, and more efficient for a country of 1.4 billion people? To understand why this matters, we must need to understand the life of an Indian currency note. Imagine a rupees 20 note. It leaves a bank. A student uses it at a roadside tea stall. The shopkeeper gives it to a supplier. The supplier uses it to pay a worker. That worker spends it at a local market. Within days, that small piece of currency may have traveled through dozens of hands. Now multiply that journey by thousands of crores of notes. India is still a heavily cash dependent economy. Yes, digital payments have transformed the way Indians transact. A QR code at a small shop can now replace a physical wallet. But cash has not disappeared. As of March 2026, currency notes worth more than rupees 41 lakh crore were in circulation in India. That means even in the age of smartphones and instant payments, physical money remains a major part of daily life. For many small businesses, rural consumers, and people with limited digital access, cash continues to be the easiest and most reliable option. So, managing these notes efficiently remains a huge responsibility. And here comes the problem: traditional Indian currency notes are made from cotton based paper. They are designed to be strong, but they face a difficult environment: heat, humidity, rain, dust, constant handling. Lower denomination notes, especially rupees 10, rupees 20, and rupees 15 notes, often wear out faster because they move more frequently through the economy. Every damaged note creates a chain of cost. Banks must sort them. Unfit notes must be removed. New notes must be printed and transported. The RBI spends thousands of crores every year on currency printing and management. So policymakers began looking at a simple possibility: what if notes lasted much longer? That is where polymer currency enters the story. A polymer banknote is not a normal plastic sheet. It uses a special material called biaxially oriented polypropylene, or BOPP. The name sounds complicated, but the idea is simple. Think of a thin plastic film that has been stretched in different directions to make it stronger and more stable. This material allows currency designers to create features that are difficult to copy. One of the most visible features is the transparent window. Unlike ordinary paper, polymer notes can include clear sections inside the note itself. These windows can contain designs, images, or special patterns that are extremely difficult for counterfeiters to reproduce. Countries that use polymer notes often highlight three major advantages: they last longer, they stay cleaner, and they offer advanced security features. Australia became the first country to introduce a complete series of polymer banknotes. Later, countries such as Canada, United Kingdom, and New Zealand also adopted them. But if polymer notes are so useful, an obvious question comes up: why didn't India introduce them years ago? The answer is India already tried. The story goes back more than a decade. In 2009, the idea of polymer currency was first considered. Later, India planned a pilot project involving rupees 10 polymer notes. Five cities were selected for testing: Kochi, Mysuru, Jaipur, Bhubaneswar, and Shimla. The reason behind choosing different cities were interesting. India has almost every type of climate. A note that survives in a dry desert region may behave differently in a humid coastal area. A currency note must survive the entire country. But the project did not move into a nationwide rollout. There were concerns about technology, practical challenges, and whether the entire cash ecosystem was ready for the transition. And then India faced another major currency event, demonetization in 2016. Replacing large volumes of existing notes became an immediate priority, pushing many other currency reforms into the background. For years, polymer currency remained an unfinished idea. Until now, the latest RBI move is significant because it is the most concrete step towards testing polymer currency again. The RBI's currency printing subsidiary, Bharatiya Reserve Bank Note Mudra Private Limited, has invited interest from manufacturers who can provide polymer substrates with advanced security features. These materials would be tested before any wider decision. The important point is this: India is not replacing all currency notes immediately. The RBI is studying whether polymer notes actually make sense for Indian conditions. And that brings us to the biggest question: what are the real advantages and challenges of moving from paper to polymer? The first advantage is durability. A normal currency note has a limited life, especially smaller denomination notes which are constantly exchanged in everyday transactions. Polymer notes are generally considered much more resistant to water, dirt, and physical damage. A note that survives longer means fewer replacements, and fewer replacements could mean saving over time. Think of it like buying a good quality pair of shoes. The expensive pair may cost more at the beginning, but if it lasts four times longer, the total cost over several years may actually be lower. The same argument applies to polymer currency. The initial manufacturing cost may be higher, but the long term calculation could be different. However, this is where the story becomes more complicated. Polymer notes are not automatically cheaper. In fact, they usually cost more to produce initially. The specialized material, security features, and manufacturing technology increase the upfront expense. Some estimates suggest polymer notes can cost significantly more than traditional cotton paper notes during production. So, the real question is not, is one polymer note cheaper to print? The real question is, does the polymer note save money during its entire lifetime? That calculation includes printing, transportation, sorting, replacement, and destruction. A currency system is not judged by the first day of production, it is judged by the entire journey of the note. There is another challenge that often gets ignored. Polymer comes from petrochemical materials. The same industry that produces plastic is linked to crude oil and natural gas. This creates two questions. First, what happens if global oil prices rise? If the raw material becomes expensive, currency production costs could increase. Second, what happens after the note reaches the end of its life? Unlike paper, polymer requires specialized recycling systems. A plastic note thrown into ordinary waste does not solve the environmental problem. So, the environmental debate is more complex than simply saying paper is natural, plastic is harmful. The real question is, which option creates a smaller environmental impact over its entire life cycle? Manufacturing, transportation, years of use, and final disposal. Countries that use polymer notes argue that because these notes last much longer, fewer notes need to be produced and transported. That can reduce the overall environmental burden. But this benefit depends on proper recycling systems. Without recycling infrastructure, the advantage becomes weaker. Now comes another practical challenge. A currency note does not work alone. It has to interact with an entire ecosystem. Think about an ATM. It is designed around the size, thickness, and physical properties of existing notes. Cash counting machines in banks are also calibrated for specific characteristics. Retail machines, vending machines, and cash handling systems all depend on how a note behaves. Polymer notes can feel different. They may be smoother, they may have different stiffness. Machines may need adjustments. For a small shopkeeper, a currency change should not create a new problem. For a bank, millions of machines cannot be changed overnight. This is why any transition would likely need careful testing. But perhaps the biggest question is, why invest in physical currency when India is becoming increasingly digital? India's digital payment revolution is one of the biggest financial transformations in the world. UPI has changed how millions of people pay. A street vendor, a college student, and a large company can all use the same digital payment system. So, does India still need better physical notes? The answer is probably yes, because digital and cash systems serve different needs. Imagine a flood affecting a region. Internet networks may fail, electricity may disappear, digital payments may not work, cash can still function. Similarly, many rural areas and small businesses continue to rely on physical money because access to digital infrastructure is not uniform everywhere. A strong economy needs multiple payment options. Digital payments provide speed, cash provides accessibility and reliability. The RBI's challenge is finding the right balance. It is not choosing between old and new technology. It is designing a smarter currency system. A successful polymer note transition would require answering several questions. Will the note survive India's different climates? Will production costs become reasonable? Will recycling systems be developed? Will machines across the country adapt smoothly? Will the security benefit justify the investment? Only after answering these questions can India decide whether polymer currency deserves a larger role. There is also a national security dimension. Currency is not just paper or plastic, it represents trust in the economy. The RBI's tender includes strict conditions regarding the supply chain of polymer material. For example, companies involved in the process must ensure that sensitive India specific production is protected from security risks. Why does this matter? Because the technology behind currency, from specialized paper and polymers to security features, is closely connected with national security. A counterfeit note is not just a fake piece of paper. Large scale counterfeiting can affect economic confidence. That is why countries invest heavily in currency security. So, what happens next? The immediate next step is testing. The RBI will evaluate suppliers, materials, and technology. If trials are successful, India could gradually consider wider use. But a nationwide replacement is neither immediate nor guaranteed. The final decision will depend on evidence, not excitement, not headlines, evidence. Because changing the material of currency for a country like India is not a small experiment. It affects billions of transactions. For an ordinary Indian citizen, the question is simple. Will this make money easier to use? Will notes stay cleaner? Will they last longer? Will the system become more efficient? Those are the real measures of success. A currency note is one of the few objects that connects almost every person in a country. A farmer receives it, a student spends it, a shopkeeper saves it, a worker earns it. Behind every note is a small story of human exchange, and changing that note means changing a system that touches everyday life. The future of Indian currency may not be about choosing paper or plastic. It may be about creating a currency system that is stronger, safer, and smarter. Because money is not valuable because of the material it is made from. It is valuable because millions of people trust it every single day, and that trust is the one thing no technology can replace. Now let us quickly recall what we have learned through our MCQ. With reference to polymer banknotes, and currency management in India, consider the following statements. Statement 1. The Reserve Bank of India has the sole right to issue banknotes in India. Statement 2. The design, form, and material of banknotes require approval of the central government after considering recommendations made by the RBI Central Board. Statement 3. An expression of interest issued for polymer substrate procurement automatically authorizes the circulation of polymer notes as legal tender. The Security Printing and Minting Corporation of India Limited is a wholly owned subsidiary of the RBI. Which of the statements given above are correct? Option A, 1 and 2 only. Option B, 2 and 3 only. Option C, 1, 3 and 4 only. Option D, 1, 2, 3 and 4. The correct answer is A, 1 and 2 only. Now let us come to explanation. Statement 1 is correct. Under Section 22 of the Reserve Bank of India Act 1934, the RBI has the sole right to issue banknotes in India except the Rs 1 note which is issued by the Government of India. Statement 2 is correct. According to Section 25 of the RBI Act 1934, the design, form and materials of banknotes are approved by the central government after considering recommendations made by the RBI Central Board. This means changing the material of currency from cotton-based paper to polymer is not simply a printing decision. It involves a formal approval process. Statement 3 is incorrect. An expression of interest is only an initial step when an organization invites information from potential suppliers. It helps understand available technology, suppliers, and capabilities. It does not mean polymer notes have been approved for circulation. A trial, evaluation, and further decisions are required before any nationwide rollout. Statement 4 is incorrect. The Bharatiya Reserve Bank Note Mudra Private Limited is the wholly owned subsidiary of the RBI. The Security Printing and Minting Corporation of India Limited is a Government of India owned public sector company under the Ministry of Finance. Thank you for watching. If this video helped you understand the story behind India's possible move towards polymer currency, consider liking this video. It helps more people discover simple explanations of important developments.